Looks like we're losing the inflation battle. Despite higher interest rates, the economy isn't cooling off as expected. And now, a major revision from the Federal Reserve Bank of Atlanta is setting off alarm bells. Let's get into it. Before we begin, remember to like this video and subscribe for more economic updates. Last Friday, GDPNow took a hatchet to its outlook for first quarter real GDP growth. The model now expects the economy to contract 1.5%, a sharp turn from previous forecasts. If the forecast holds, it would be the first economic downturn since early 2022. That sudden shift got the attention of Boston College economics professor Brian Bethune, who warned overall economic growth is in the process of slowing down at an alarming rate. Now, to be clear, GDPNow is not an official government forecast, but it is a widely respected real-time estimate that adjusts constantly as new economic data rolls in. So what triggered last Friday's sharp downward revision? One big factor: consumer spending collapsed. Fresh data showed spending fell 0.5% in January, its biggest drop in 3 years. That's a serious miss, considering analysts expected a slight increase. Then there's exports, or rather, the lack of them. Net exports plunged, dragging GDPNow's growth estimate down from minus 0.4 percentage points to a staggering minus 3.7 percentage points. But here's what's really concerning. GDPNow's forecasts haven't just dipped, they've been free-falling. 1 month ago, it projected a 3.9% growth rate. 2 weeks ago, that fell to 2.3%. Now, a potential contraction. And GDPNow isn't alone in flashing warning signs. Just 2 days before its latest update, another major recession indicator reared its head: the inverted yield curve. Last Wednesday, the yield on 10-year treasuries dropped below the 3-year note, a classic sign that investors may be bracing for an economic downturn. Now, an inverted yield curve doesn't guarantee a recession, but here's the kicker. It has preceded every U.S. recession since the 1970s. And if that wasn't enough, consumer sentiment is taking a beating. The University of Michigan's Consumer Sentiment Index fell nearly 10% in February, hitting a 15-month low. Meanwhile, inflation expectations spiked from 3.3% to 4.3%. Not exactly what the Fed wants to see. Over at the Conference Board, their Consumer Confidence Index dropped nearly 7%, its worst monthly decline in over 3 years. But here's the real red flag. The Expectations Index, a key indicator within the report, fell nearly 10 points, landing in a range that historically signals a coming recession. Now, does this mean an economic downturn is a sure thing? No, but it does highlight how uncertain the economy is right now. And some experts believe that Wall Street isn't paying attention to the risks. Chartered financial analyst Chen Wei put it bluntly: it's a time when investors should be prepared for anything. And Joseph Brusuelas, chief U.S. economist at RSM, echoed that sentiment. My sense is that the complacency that has crept into asset markets is about to be disrupted. So what happens next? Well, time will tell if these warnings play out. But with GDP growth estimates nosediving, consumer sentiment plunging, and inflation still a problem, it's no wonder why some experts are on edge. Until next time.